Hello, hi. My name is Jerry Miller from Trendsignal, the trader education company. This is part of our Monday Market Insight series. Today I'm going to be talking about what's really happening this week with US employment data, that's non-farm payroll, and also UK interest rates, and also a bit of a review of what happened last week. We were discussing the US interest rate rise and their first reading of their gross domestic product. So without further ado, let's get the first one up, slide up. So last week's data, US interest rates. Well, we were predicting a 0.75% rate rise, and the Federal Reserve duly delivered. You might be wondering why the stock market's actually had such a good week, but I think there was a combination of factors that resulted in the stocks racing higher. Firstly, we were expecting at one stage, following a 9.1% CPI reading in the US, that the Fed would raise rates by 1%. And over the last sort of 3 weeks, those sort of expectations have moderated slightly. I mean, not massively, but we still had a 0.75% rate rise following a previous 0.75% rate rise. So, the outlook for interest rates is still quite hawkish, but it's modified a little bit to the extent that year-end rates in the US are expected to be around 3.25, 3.5, rather than 3.5, 3.75. And the risk is that perhaps it might be even lower than 3.25%. But the Federal Reserve also came out and said that the path for higher rates is not so clear anymore, and they're looking to consider the effect on the economy. And of course, with increasing rates, higher rates, has effect on companies' ability to borrow cash. The cost of servicing all those debts has gone up. So it really has a slowing effect on the economy in itself, and it's that effect that the Fed has to keep an eye on. Um, and that's really sort of what their focus will be. Another thing that happened straight after the Federal Reserve's interest rate decision on the Thursday, we had GDP data out, and we were talking about lagged and leading indicators last week, and GDP is very much a sort of backward-looking indicator, but actually it's something that some economists feared. We actually got a negative GDP reading. If we just have a quick look here at that data. So I'll just open up a calendar from Forex Factory just to show you the data that came out. And as you can see, the GDP data reading, let's get onto the right week, might help. Let's just go back one. Okay, so you can see the GDP reading here came in at minus 0.9%. Now, it's just so far from what was expected. And actually, it's the second quarter of negative growth. So that's really the traditional definition of a recession, which is 2 quarters of negative growth. But it seems at odds with a lot of other bits of data coming out, notably employment data that we're going to be looking at in a second, within the unemployment rate at just 3.6%. And in fact, the US have got their own committee that look into the data in more depth than just the GDP reading, and that committee does not believe that the US is in a recession, and neither do many economists for that matter. Okay, let's just flip back to the slideshow. Let's get on to the bits coming out this week. Most important for those of you living in the UK, we've got the Monetary Policy Committee. That's the rate setting committee of the Bank of England. And like other central banks, they meet monthly, or in fact 8 times a year, but it's always described as the monthly policy meeting. And it's quite interesting here in the UK with inflation running at 9.4%. Andrew Bailey, quite rightly actually, warned the market that the bank would be considering a half-point hike in interest rates. Up until Bailey discussed this, I think the market was expecting a quarter-point rate rise, but it looks like that we're going to get a half-point rate rise. And really, when you look at what's happening with inflation, I think it's the only decision that they can make, with inflation running at 9.4%, albeit there has been a bit of a pullback in base metals. grains, soft commodities over the last couple of months, precious metals as well. But base metals, the likes of copper, has come back, I think, up to 35%. Grains, that's corn, wheat, soybeans, have all retraced quite a bit, along with cocoa, coffee, and sugar. So the picture may be a bit more complicated, but I think with elevated energy prices for quite a while to come, that inflation is going to remain quite stubbornly high. And in fact, they reckon 11% here in the UK. So rates are going to be heading sort of to 2.25% by year end. At least that's what's expected. Next, unemployment data. Unemployment data in the States is important for a couple of reasons. Firstly, it's a great bellwether of how a particular economy is doing. And secondly, unlike other central banks, the US central bank, that's the Federal Reserve, one of their mandates is to foster full employment. The other, obviously, being maintaining price stability, like other central banks. But they have that, so they have to have a very sharp focus on the unemployment or employment picture. And so the monthly reading produced by the Bureau of Labor Statistics really attracts a lot of attention. So this US unemployment data, or commonly referred to as non-farm employment change, non-farm because the US has got quite a large seasonal farming employment picture, and a lot of that ebbs and flows depending on the seasons, obviously. So they smooth that out by removing the farm jobs from the report. So what we're expecting with non-farm employment, let's just have a quick look again at the calendar. So here we got the calendar. So for the end of the week, again, shift back to the right week. Okay, so here we've got US unemployment data on Friday. We're still expecting 250,000 new jobs. The reason why I say still expecting, for those of you following the markets last week, and have just mentioned that the GDP data last week pointed to a contraction in the US economy in the second quarter. That's between April and June, having had a negative quarter between January and March. This doesn't really stack up, of course, when you look at what's happening with the employment picture, with close to record high employment, with an unemployment rate of 3.6% and 250,000 new jobs expected. It is something that is particularly volatile and is declining. That chart's not actually that helpful because of the slump in the start of the pandemic. But actually, the employment picture is starting to soften, but nothing like as much as would indicate a recession. Anyway, it's something that the US Central Bank, the Federal Reserve, and its rate setting committee, the FOMC, do follow. But really, recession? No, I hear you say recession. What recession? But we're expecting, as I said, 250,000 new jobs. Markets very sensitive to this data, not just US markets, global markets, really. There's a lot of them take their cue from the US. Anyway, that's it. Thanks very much for listening.